My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to save you a little money. My job is not just to educate you and teach you, but to put it in perspective so you don't just panic. Call me at 1-800-743-CBC or tweet me, Jim Cramer. Whew, what an ugly day. Just hideous. We came in today knowing we'd have a critical non-farm payroll report. If you were a bull, you wanted to see weaker than expected hiring with wages pretty much in line, because that's what the Fed needs to see before it can start cutting rates. Voila! We got exactly what we wished for. Maybe we should have been careful, though, what we wished for, because the bulls vanished while the sellers came out of the woodwork and crushed practically everything. Dow falling 410 points, S&P plunging 1.73%, and the NASDAQ plummeting 2.55%. This market has a September problem. Come September, we're always hit with a tremendous amount of profit taking, hence why it's the weakest month of the year. I know that's somewhat circular reasoning. We sell because we've always sold, but it makes more sense than saying people sold tech because they fear a hard landing. Tech, especially big tech, is something you buy, not sell, into weakness. If you're worried about a more severe slowdown, why? Well, you do it because big tech is all about powerful secular themes that can keep on trucking even during a recession, and we're not getting one. I'm talking about the data center, accelerated computing. They're not going anywhere. Nevertheless, when anything jars the big tech themes of the moment, the market's reaction is swift and harsh and horrible. Look at what happened after NVIDIA reported. Last night, Broadcom gave us results that showed a tad bit of weakness in artificial intelligence orders. And the pin action? It took down the whole darn cohort. I don't believe AI is a bubble, but these stocks are still up a great deal, especially in August. And September tends to bring out sellers in just in-line numbers. You know, that's what we got from Broadcom. It was in line. It wasn't a shortfall. The issue here is not the reaction of Broadcom that took down most of tech. No. It's the overreaction of Broadcom that seemed to cascade into finance, and then anything cyclical. The pain was palpable.
The House of Pain.
To me, this is all about the zeitgeist and not the facts, because so many companies are doing well despite the slowing economy. However, you can't waste time arguing with the sellers who suddenly want nothing whatsoever to do with this market. Sell. Nothing's going to stop them from taking profits out of fear. I can't blame you for joining them if you do, but only if you don't have enough cash. If you have cash on the sidelines, please don't join them. For the Charitable Trust, we got plenty of cash because we've been selling this market ever since we got that crazy rebound off that weird decline in Japan. And now we're looking to buy, not sell, as we go from usually overbought to moderately oversold. But we're in absolutely no hurry to pull the trigger. Because, again, September tends to be terrible. And real long, at least from here, doesn't it? You don't need a calendar to know which way the wind blows. Which brings me to the game plan for next week. On Monday, well, we find out if tech can maybe make a stand thanks to two different discrete and positive events, I believe. First, there's the new iPhone launch, the one with the built-in AI component that Apple didn't even have to pay for. I'm optimistic, but by the way, launches have never really produced big moves in the stock. Then after the close, we get results from Oracle, which has reinvented itself with an AI kicker to go with its regular enterprise software business. As of last quarter, it's been performing exceptionally well. I think they're going to do it again. Apple and Oracle could staunch the tech blood flow. Again, that, however, is the beginning. Against that is, this is really going to be unfortunate because you hear about it endlessly. The beginning of the Justice Department trial against Alphabet for its anti-competitive practice in online advertising. Justice recently beat Alphabet in a case involving its monopolistic practices when it comes to search. I think Alphabet has a stronger case this time around. But either way, it will drag on and produce a constant drumbeat of negative headlines. Tuesday, GameStop reports that always engenders rabid animal spirits. In fact, GME shares popped today after Keith Gill, a.k.a. Roaring Kitty, posted a picture of Toy Story on X. Yeah, seriously. The original meme stock always seems to have a lot of promise, but never translated into anything real, like earnings per share growth. It's time for the company to reveal a long-term business plan, or the quarter will just land with a thud again. Tuesday night's the great debate between Vice President Harris and former President Trump. I don't know how much of a role the economy will play in the debate. If Trump's on his game, he'll try to tie Harris to the inflation that we've experienced since COVID. I suspect that Harris will try to portray herself as a more moderate than President Biden. Either way, I doubt there'll be anything specifically market moving. Even if candidates say anything newsworthy about their tax plans, keep in mind that the winner in November likely won't have the Senate votes to totally rework the tax code, whether we're talking Harris's capital gains tax or Trump's 19th century style tariffs. Wednesday, we get another read on inflation. Now, this time it's from the Consumer Price Index. What can I say? As long as inflation stays the same or goes lower, the Fed has plenty of leeway to cut interest rates and prevent a recession, the thing so many of the sellers are worried about. That's why I keep telling you, please do not give up the ship here. Now, it's a very quiet time for corporate earnings, but not Thursday. At the open, we hear from Signet Jewelry. Now, Signet is a total hot-button story because we've seen a terrific string of quarters until the last one, which was definitely poorly received. I think CEO Gina Drosos has really turned the company around, and she's been on the show many times. And while we're getting some hiccups, I believe the stock's relatively inexpensive. That said, Signet's such a wild trader that I put it in the category of not for the squeamish. Kroger reports the giant grocery chain, and I think it will once again talk about how much it needs to close this deal to buy Albertsons and why there's nothing monopolistic about the merger. They don't have too many overlapping stores, and they plan to divest the ones that do overlap to a well-financed competitor. I'm just not sure any of that matters because the Federal Trade Commission seems determined to block the deal no matter what, which means Kroger stock will have to stand or fall on its own merits. Fortunately, its own merits are pretty darn good. Finally, Adobe reports after the close. Now, we've had 3 positive analyst notes ahead of this quarter, which is extremely bullish. Against that, of course, is the fact that Adobe's tech, and it has an AI component, which is now suddenly a guilty until proven innocent complication to an otherwise magnificent story. That said, I sense that this should be a good result for the bulls, given that the analysts are promoting it so aggressively ahead of the quarter. So we're getting oversold. Not there yet. Just check the oscillator. We're still not in negative territory. We have some possibly good earnings coming up. But against that is a budding fear that expectations are too high versus an admittedly slowing economy. Oh, and it's September. Bottom line, this is just a rather unforgiving moment until stocks go lower enough to attract real buyers, not traders, and we get close to the end of September. Until then, you can try your hand at being nimble on any rip up and do some selling, where you raise a little cash, stand pat, and then wait for lower prices to do some buying. I like the latter course. I think that will be the most lucrative. Let's go to Scott in Colorado. Scott.
Hi, Jim.
Scott, what's happening?
Hey, thanks for everything you do.
Thank you. Thank you. Days like today make me wish I was just better. What can I say? Go ahead. I'm sorry. I didn't mean to interrupt.
Hey, what do you think of Blackstone, both near term and longer term?
All right. I'm glad you distinguished between the near term and the longer term. Near term, I don't have a lot of conviction. The stock has had a very big run from the 120s to the 130s. Longer term, I think Jonathan Gray and his team are simply brilliant, and their actions that they took this week in the data center are very strong. I like it. Let's go to Mark in Iowa. Mark.
Hi, Jim. I'm a member since the beginning of the investing club and glad that I have been.
Oh, thank you. We're going to keep trying hard. I'll try to do a good piece for you on Sunday, put a lot of things in perspective. How can I help now?
Well, 2 things. One, are the Eagles going to run Barkley more than they ran Henry last night?
Let me dial in and see exactly what Coach Nick is thinking. But we do have Kellen Moore, the offensive coordinator, seems very partial to Saquon. How can I help you?
Hey, you were pounding the table a while back to buy this stock when it was clear down to a little over 76. I picked up about a quarter of a position in it, and then it went up from there, and I just didn't get back to it. I'm wondering what I should do with a quarter position of GE Healthcare.
Okay, I want you to hold it because it is a rate play. As rates go down, the hospitals will buy more equipment. I think rates are going down. So therefore, I think that you use the market's weakness to pick up some more if it goes below 80. Otherwise, no, you stand pat. All right, now listen, it's an unforgiving moment for the market, a jarring, tough moment until stocks are low enough to attract real buyers and not just the flippers. So stay focused and stay nimble. On Mad Money tonight, are the bears roaring louder than they should be about the latest action in AI? I'm investigating. Then I've got a behind-the-counter exclusive with the CEO of Sweetgreen to see if it's a buy at these very levels. Plus, after falling nearly 50% this year, I am eyeing the decline in Lululemon. You do not want to miss what I have to say, so stay with Cramer.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Is it possible to prick the so-called bubble in artificial intelligence spending and still like the stock of NVIDIA? Can you buy tech hardware when Broadcom, a huge tech hardware play, reported an otherwise solid quarter where it nevertheless failed to blow away the artificial intelligence estimates? First, let's get some perspective, please. NVIDIA reported an excellent quarter, and its stock remains up 108% for the year. Do you know that's still the best performer in the S&P 500? Broadcom's no slouch either. The $638 billion company, I bet you didn't know it was that big, has a stock that's up nearly 23% year to date. So why are their shares finally rolling over? Because of a new and negative AI narrative. We know the hyperscalers, those gigantic companies that are also known as Magnificent Seven, have been spending like mad on AI infrastructure, and there's now a widespread belief that they're spending too much, and therefore it's not sustainable, which is how many people read the relative underperformance from NVIDIA and Broadcom after those most recent quarters. But you know what? That's just plainly, it's just inaccurate. NVIDIA got hurt because they're having trouble manufacturing Blackwell, their next generation AI chip. It's hurt their gross margins, and it also means they don't have enough supply to meet the demand, at least for the moment. Still a high-quality problem, but one that is taking its toll on short-term investors who seem to be fleeing like mad. At the same time, spending for new AI hardware is very uneven depending on the customers. For example, Ben said, Melius, I quote him a lot because he's a really smart fellow. He said that Broadcom was hurt by some choppiness in Google orders. Now, that wasn't clear from the conference call, but it makes a lot of sense. And that business will bounce back. In the end, though, these two stocks are unwitting casualties of a widespread belief that AI spending is peaking, at least among the tech titans. Now, I disagree with that. These hyperscalers are always thinking of how wise it was of Google to spend so much versus Bing. You know, they were once legitimate. You know, the Bing was a legitimate contender to be the leader in search. But you know what? It just wasn't going to happen because Google would not stop spending. And Microsoft didn't spend enough on search, and it cost them dearly. If Meta AI is going to compete with Gemini, which is Google's, or Claude, or ChatGPT, it needs more chips from NVIDIA. It's the only way you can distinguish yourself. Is that circumstance part of a bubble? Or is it just a struggle to stay relevant in the AI arms race? A race that all the hyperscalers must be in and can't afford to lose. Broadcom is more than AI, by the way. It also stands to gain from its VMware acquisition, and it turned cell phone chips could be coming thanks to the new iPhone coming up. Even if the demand for their hardware from the tech titans comes in lower than expected, it might be fine at this point. After all, now Broadcom, after this sell-off, trades at around 22 times next year's earnings, roughly in line with the average name in the S&P 500, which is ridiculous given its years of well above average growth. If you want to learn more, we did a huge wall-to-wall dive on Broadcom for club members today, and I think it's quite compelling, and you should read it. Ultimately, I believe that the AI infrastructure remains the greatest story of our time. The data center, the hardware, and the software for it are so much stronger than the bears think. Look, it's wide-ranging. Just listen to Jim Umpleby, the CEO of Caterpillar, talking about incredible demand for data centers filled with Broadcom and NVIDIA chips and how it's worldwide and it's powerful.
We're seeing data center demand globally. And so this is not something that, again, is just in one geographic area, and it's not just with one customer as well. So we're seeing a lot of demand from, of course, the big hyperscalers, but also smaller customers and companies, frankly, that most U.S. investors aren't aware of.
Now, we played it this morning on Squawk on the Street. That's an incredible comment. And it was really kind of overlooked in a day which was horrendous for tech. Now, let's step back for a second. We're in September, historically a terrible time for the market's best performers, like tech, and a very good time for stocks that have little economic sensitivity, like Clorox or Hershey, American Electric Power, United Health Group. They're in ascendance right now. That's not an unusual pattern, as many winners get dumped in September, and the fair to Midland companies get bought as a catch-up trade. I believe that this dichotomy between cyclicals, including tech, and recession-resistant stocks like the ones I just mentioned, will last for pretty much the whole month, as we get the major turnover from winners to losers. But in the end, people will realize that there's no AI bubble. There's just intense demand and very little supply. The Magnificent Seven have had repeated periods of underperformance, but they tend to always come back as they should. They're all incredibly well run, and they have both accelerated computing and artificial intelligence. That's 2 wins behind their back. Last I looked, that's a pretty darn good place to be. Mad Money's back after the break.
Coming up.
This is a very special Sweetgreen. We're at the Infinite Kitchen. Tell us about where we are.
Next.
Lately, we've been saying some very good things about Sweetgreen, the fast casual dining that's become one of the best performing restaurant stocks of the year. These guys have been able to generate phenomenal same-store sales growth as they expanded beyond just selling salads. At the same time, Sweetgreen's rolled out these amazing infinite kitchen machines, that's what they call them, that automate the salad making process and look incredibly cool in the process. That said, over the past week, the stock's come down dramatically along with the rest of the market. And now maybe you're finally getting a nice discount. Is it worth buying on with us? Earlier today, we took a trip to Sweetgreen's Penn Plaza location, heart of Midtown, in New York, to check out this new infinite kitchen technology and speak with Jonathan Neiman, the co-founder and CEO of Sweetgreen. Take a look. Jonathan, thank you so much for having us. This is a very special Sweetgreen. We're at the Infinite Kitchen. Tell us about where we are.
Jim, it's such a pleasure to be here with you. So we're here in New York City, in Penn Plaza, at the first Infinite Kitchen in New York City. This is our first retrofit that we've completed. So taking an existing Sweetgreen and implementing this new technology. So the Infinite Kitchen is our automated co-pilot solution to help us make a better experience for our team members, for our customers, and better financials for our company. And so what it does is it assembles every single meal at Sweetgreen. We're able to assemble about 500 bowls per hour.
Which is incredible.
But what's important here, and you'll be able to see, is at Sweetgreen we have a huge commitment to the sourcing of the food, the craft of the food, and the hospitality. And so when we designed this experience, it was really intentional around making sure everything starts and ends with human hands. We prep all the food here, we're cooking everything, we're making the dressings. The automation helps us assemble so we can make things fast, fresh, and perfectly portioned, but we're still having that hospitality component where you do have a team serving you that food.
Now, you've clearly thought through this because the perception is if you've got great throughput, you have no hospitality. If you have great hospitality, then you're backed up. So I know a lot of these things are because you're a restaurant guy, you're looking at this stuff, and you need all of these things in order to make it so that you can hit your numbers, but also well exceed it and not have a terrible line and have the food be great.
Absolutely. I remind our team all the time, we are a restaurant company. We are a food company. Technology is a great enabler, but that's not what we do. The technology just helps us create better experiences for our teams and for our customers so we can execute our mission better. But at the core, it's about the food, it's about the experience, about the brand.
Now, I also want to point out that when you did the steak with caramelized onion, we also realized it's about day parts.
Absolutely.
And it's not a salad company, for heaven's sake.
I mean, you hit it right on the head. For us, from the beginning when we started, it was really not about salads. It was really about the quality of the food and wanting to serve healthy, craveable food at scale. We started with salads. It was our first vertical, but it was always about taking that license from the brand offered as well as the supply chain we have and expanding what we do and what we serve. So last year we introduced plates, which has been a huge hit, a number of plates where it takes that quality promise that we have, but no lettuce, it's not lettuce-based, so it's grains, proteins, grilled veggies. People are loving it. It's driving a broader consumer, bringing more men, driving dinner. And then just a few months ago, we launched caramelized garlic steak, which has continued to double down on that. And I think you can expect a lot more of that as we look forward. We're really not looking, again, to be a salad company. We're looking to serve craveable, delicious, healthy food.
Now, you mentioned more men. I have not heard that from a restaurant chain, so to speak. Why does that matter?
We do really well with women. We always have, I think, given the impression that salads give. What's interesting is once people try Sweetgreen, they realize it's not their typical salad. It's a filling bowl. You have a lot of protein in it. It is, it's delicious and craveable. But a lot of that is starting to shift the positioning that we're great at salads, but it's more than that. And our goal right now is really, to invite all sorts of consumers. Our goal, we want to be a national and eventually global brand. And in order to do that, we need to make sure the portability is there and we can attract all kinds of consumers.
Okay, on Mad Money, what we've always been looking for are quality places that go from regional to national. Is a gating factor trying to have fresh produce in different cities?
There's a few gating factors as we expand. So the supply chain is definitely one of them. We do set up a new supply chain in every region we go. At this point, we've set up supply chains across the country. We're in about 20 major markets around the country. So, almost 240 restaurants, nationally with a national footprint. But the gating factors beyond supply chain really has to do with people. It's, for us, we have a huge goal of promoting as many managers or head coaches from within. And so much of that is building the bench and the pipeline to make sure we're delivering on our promise.
One of the things that I found about you guys, you've worked really hard before you came public. And one of the advantages you had is therefore you're not putting through a huge amount of price. People are very worried about the price given what your word, choppiness that we have. How are you able to rationalize the high quality food, local source, reasonable price, and pull this off all over the country?
Obviously, there's been a ton of inflation over the past decade. I think I read yesterday that food away from home inflation's been about 51%.
Too high.
It's a ton. Luckily for us, it's been less than that. So while Sweetgreen has always been a premium product, and given the price we pay to our farmers and wanting to pay a fair wage to our team members, it's always been premium price. But over the past 4 years, our relative pricing advantage has actually improved. If you look at us versus our fast casual peers, and again, looking us versus QSR, the difference has really shrunk. So we're seeing a real opportunity here as people trade up from QSR and other fast casual, and we're also seeing a big trade down opportunity, especially with dinner. So now when you can come and get the salmon bowl for $15-16, while that could be a little bit maybe pricey for the lunch side, for dinner, that's incredible value.
Now, let's talk about Infinite Kitchen, or IK, as you say. Now, this is an extraordinary device, basically, right? I mean, this comes purpose-built.
Yeah.
And you have a lot of stores. Could this be the model for all stores?
So we're really proud of what we built. I got to give a shout out to the team who built this, our Spice team that built this fully. They designed it, they built it, and now they're scaling it. Very proud of the work they've done. It's a company we acquired about 3 years ago and have been working in tandem to roll this out. So we've 4 of them open today. We've had 3 new restaurants featuring the Infinite Kitchen, and this being the first retrofit. We do believe there's an opportunity over time for all new restaurants to feature an Infinite Kitchen. So next year, over half of our pipeline will feature an Infinite Kitchen, and we expect that percentage to increase over the years. We also think there's a pretty big retrofit opportunity. Probably not all stores. There's some stores where the size or the volume may not quite be there, but many of our stores have the opportunity for a retrofit, and we're going to learn a lot with this one. I'd like to say it's still early.
Okay.
It's just opened a month ago. First retrofit. We're seeing how customers feel, how team members feel, understanding the return metrics. But so far, the results have been very promising.
Now, you're a student of the game, so to speak. You really understand restaurants. Do you try to take the best of a Chipotle, take the best of a Cava even, take the best of McDonald's, which is low end, and just kind of look through everything, try to avoid the Starbucks situation where there's too much complexity? Or is it just your lab and you don't care about the other guys? You want to do it right for the customer?
I'm a student of business. That's from the time I was a kid. I've just loved studying business, reading biographies of business leaders, and it's something I always knew I wanted to be an entrepreneur. Even Ray Kroc. I learned from all of them. Actually, the Founder movie is one of my favorite movies. It's an incredible movie. The scene where they're in the kitchen laying everything out, that's something we do all the time. Where you're running the time test and you're figuring those things out. And so I'm a student of the game, not just food though. There's a lot to learn from food, but we like to learn from all kinds of consumer brands. And really, one of the philosophies at Sweetgreen is this balancing of art and science. I believe the best consumer brands have a really thoughtful approach around the art, which is the story, the feeling, the soul, the food, the creative. But the science is equally important, how we enable that through the technology, the data, and all of those other pieces. And so I think, we've really tried to merge these two ideas in every single thing we do.
One of the things that Danny Myers taught us, been frequent guests on the show and setting the table, he talks about it has to be hospitality. Now, it would seem that the combination of this, the Infinite Kitchen, freeing people up, And the fact that you are therefore not laying off people, but you're actually increasing hospitality is a way to be able to really to gain more customers based on this. It's a formula that is unique and usually only for really expensive restaurants.
Yeah.
So you've got hospitality down to a person, to people right up front.
It's something we're really, really focused on. For us, it's really one customer at a time. And the idea with the Infinite Kitchen was, most restaurants, as they get bigger, the experience starts to crater. Right. It's just with scale, it's a lot of little decisions. And what typically happens is you'd start to move things away from doing them in the restaurant. Right, so you prep out of the restaurant. You start cooking things off-site and building commissaries and all those things. And people may not taste that at first, but over time they do. For us, the brand is built on the supply chain, the quality of the supply chain, and the craft and the handcraft nature of the freshness of our food. We did not want to take that away. And so we thought, is there a different way to approach this? Can we implement technology that allows us to elevate the experience and elevate the product and make it so we don't have to get rid of the prep in the store? We can maintain the part that the customers really care about, that they can taste, which is the preparation of the food and the culinary piece and the hospitality. And then this piece in the middle we can automate that makes that job easier. And so what we think this is going to enable us to do is to protect the quality of the food as we scale.
Now, one last question. Again, keeping with the regional and national, this works everywhere in the country, doesn't it? You can build one of these anywhere, and it works. Columbus, Ohio,
Yep.
last 2 days.
We opened in Columbus on Tuesday.
Right. So should we expect 1,000 stores?
We think over time it's many more than 1,000. If you look at just, a comp you brought up at Chipotle, there are about 4,000 restaurants today. If you look at what we serve, the price point, the flavor profiles, the different day parts that we have, and the frequency of our guests, we think the TAM is absolutely massive. We've proven it. When we started the company, it was, it's a DC only brand, and then it was a Northeast thing. Today we have stores across the Northeast. We're all, in the South in Texas, all over California. We've proven some really hard to operate markets, places like California and Seattle, to places like, the Midwest, which we've been expanding in the past few years with a lot of success. So we do believe it's something that will work everywhere in the U.S. and eventually globally as well.
Well, I want to congratulate you on your measured success, your emphasis on hospitality and great food, and being able to put through people so we don't have real long lines, which is what we care these days. Jonathan Neiman is the co-founder and CEO of Sweetgreen, and we're so glad that you let our team in to show this truly marvel in the restaurant and hospitality business.
Thank you. It's such a pleasure.
Thank you.
Coming up, Lululemon and The Gap are reaching for the same retail dollars. Who can stretch their stock farther? Stay tuned.
How low can Lululemon go? Going into last week's earnings report, the stock had already been cut in half from its highs last December. And when the company posted its numbers a little over a week ago, the results were mixed at best. No real sign of a turnaround. The stock barely got dinged on the numbers. But as the market weakened this week, Lulu's stock declined more than 2%. Now, the truly sad part is that until late last year, Lululemon was one of the greatest growth stories of the past 15 years. You could have bought it in single digits during the Great Recession. Now it's at $253 and change, which is an incredible long-term move. But it's a lot less impressive when you remember that Lulu was at above $500 stock about 9 months ago. So is there any hope for a comeback buried within the latest quarter? Given the company's historic track record, I think we owe it to ourselves to take a look. Unfortunately, while there are some positives in there, no doubt, they're not enough to make me a believer again. Not yet. And you need to be a believer if you're going to stick your neck out to recommend a stock that's been cut in half in less than a year. I can't bring myself to do that for a number of reasons. For starters, last week's quarter really wasn't that good. While Lululemon delivered a 20-cent earnings beat off a $2.95 basis, that looks good, right? Thanks to higher than expected margins. They also had pretty discouraging revenue, which came in a little light, and just 2% same-store sales. Wall Street was looking for 5.9%. That's big miss. When you dig deeper, all the strength is coming from overseas. Lulu's international business had 19% same-store sales growth. That's tremendous. Their American business saw 3% shrinkage. That's the core business we're talking about. That's bad. The deceleration has been remarkable. Lulu had 12% overall same-store sales growth in the fourth quarter of last year, which slowed to 6% in the first quarter of 2024, and then 2% in the most recent results last week. Sell. The guidance didn't inspire much confidence either. For the current quarter, Lulu had a really light sales outlook and an inline earnings outlook. For the full year, they cut their sales forecast. Previously, they were looking for 11 to 12% growth. Now it's just 8 to 9%. Management trimmed their full year earnings forecast too, but Wall Street already saw that coming. So we got a company that's struggling in its core areas, even as that's somewhat canceled out by phenomenal strength overseas. Lulu's international revenue shot up by 29%. And you know what? These guys are killing it in China, which is up 34%. They're also doing very well in Europe, which is weak for everybody else. The Middle East, just okay. In Africa, Even Canada is fairly robust for these guys. It's just the U.S. that's awful. Quite a good statement overseas, though. Of course, even with these challenges, Lulu's not a bad operator. They managed to deliver some very healthy margin expansion thanks to lower product costs and lower than expected markdowns. The analysts figured these guys would get clobbered by markdowns, but that just didn't happen. I'll give them a polite, kind of tennis or golf clap. And look, the people who run Lululemon seem confident they can turn things around, or else they wouldn't have just bought back $1.2 billion worth of stock in the first half of the year. Whoa! Something that was a major contributor to Lulu's earnings per share beat. However, Lulu hasn't been great at timing these purchases. They paid an average price of $395 per share in the first quarter, and then $310 the second quarter. I mean, that's not that great for a stock that's in the 250s, is it? At the end of the day, the problem here is very simple. Lulu's lost traction with its core customers, women in the United States. Lulu actually seemed pretty pleased with its men's business, but confessed to I'm going to quote this, slowdown in women's. To its credit, management addressed the issue head on, admitting that they dropped the ball by introducing fewer seasonal updates on their products. Even yoga pants were impacted, and that's the heart and soul of the business. Lulu also had an unfortunate incident we need to talk about where it had to pause sales for a new leggings line, and that was called Breeze Through, because of customer complaints that the unflattering back seam gave them what they called long butt. Now, that's a new term for me, candidly. But it's crazy that they had such a problem with this. Historically, Lululemon was pretty consistent about trying to make your butt look pretty good. I don't know. I mean, maybe they've lost sight of that. What's the point here? Now, on the conference call last week, management said they're trying to correct their mistakes and turn things around. They replaced the product leadership along with part of the merchandising team, which, by the way, was applauded on Wall Street. They plan to fast-track new products and bring in more seasonal merchandise. CEO Calvin McDonald, Total Pro, said he's confident that they've got the situation under control, adding that, quote, I'm excited about the newness and innovation that will be flowing into our upcoming product assortments, end quote. Hey, we should also note that just yesterday, we found out, and a very encouraging thing, regulatory filing, that McDonald is putting his money where his mouth is. He just bought over $1 million of Lulu shares in the open market on Tuesday. We always tell you that insiders sell their stock for a variety of reasons, but they only buy it for one reason. They think it's going higher. I thought it was an impressive statement. I want to give him the benefit of the doubt. After all, he made a lot of money for shareholders from 2018 through 2023, but I don't think he addressed the real problem here. See, I think Lulu's core business is struggling simply because there's a ton of competition in the athleisure space. There didn't used to be. And comparatively, Lulu's merchandise tends to be pretty pricier. How about pricing? So if you're looking for leggings, you might want to go to Vuori or Alo Yoga or Beyond Yoga or Fabletics or Outdoor Voices or Gap's Athleta brand or American Eagle's Aerie brand or FP Movement, which is an offshoot of Free People itself, an offshoot of Urban Outfitters. Many of these brands sell similar merchandise for a fraction of what you pay at Lululemon. While Lulu was proud of the fact that it was able to defend its high price points last quarter, and they should be, I keep feeling that this is a key reason why they're losing their core customers in America. At the end of the day, Lululemon can fix its fashion assortment, and it can cut its guidance to the point where the numbers will be easy to beat. But there's no cure for competition. And until they figure out how to get a real edge on all these new entrants, it's hard to see Lulu making a comeback. While Lululemon's doing well overseas, you got to really hand it to them, especially in China. The China economy is a mess, and virtually every other Western company that operates over there is in trouble. The core business remains in the United States, and right now, Americans are pushing back against high prices. So it's no wonder that America's same-store sales were down 3% this past quarter. Now, you could argue that Lulu is worth buying purely on the basis of valuation. It sells for roughly 18 times the midpoint of this year's earnings estimates, when historically the stock has sold for a whopping 43 times earnings for the past 5 years. But to make an argument on valuation grounds, you need to believe that there could be no more number cuts coming. I can't say that with confidence when it comes to Lulu, at least not yet. Not with this much competition, including the re-imaging of Athleta by parent company Gap. Next up, according to Richard Dixon, the Gap CEO, he's going to take a hard look at this and try to fix it. Now, here's the bottom line. I'm rooting for Lulu to make a comeback, absolutely. But there's so much lower price competition that I'm simply not ready to stick my neck out on this one. For now, look, I as much as I think Calvin McDonald's a total pro, this is still a show-me story. Let's go to Afzal in New York. Afzal.
How are you, Jim?
How are you?
I love your show very much.
Oh, thank you.
I need advice for my retirement stock. I have the Keurig Dr. Pepper symbol KDP. His dividend is 2.32%, and insider owns 21.82%. So I need your advice, Mr. Jim.
I think that this stock, even though it's been a horse of late since we decided to get out of tech, I mean, we being the market, I think it still sells for only 20 times earnings. I think you can go higher still. Let's be careful. This group has had a big move. But I've always liked the company, and I've always liked Bob Gamgort. And now it looks like all his hard work is paying off. The great CEO. All right, now I'm rooting for Lulu to make a comeback. But for now, I think this is still a show-me story. It's too bad. We all wanted to do better, don't we? Bad Money's back after the break.
Coming up, hit us with your best shot. An electrified fast fire lightning round is next.
It is time. It's time to the light round. I'm saying the numbers. I started by sell this because another core stock question. At that time, I stand for the planet sale. And then the lightning round is over. Are you ready? Ski, Dad, it's time for the lightning round. Cramer, Mike. We're going to start with Andrew in Florida. Andrew.
Jim, thanks for taking the call. This is GE Vernova.
I like that stock. I'll tell you why. Because we're all looking for situations where we can play the environment and corporations, and we've got it. Okay, let's go to Dave in Illinois. Dave.
Dr. Cramer, my old man friend. Happy Foxborough Friday.
Well, same to you, Dave, and good to have you on the show. What's going on?
Jim, a spinoff of Danaher, Veralto. What do you think?
I think it's a very well-run company. You know, they're doing a lot of great stuff. We did look at it hard to be able to keep both this and Danaher. It looks like, of course, that we should have. It is a highly valued stock, though, Dave, so I'm not sure how much more we can go higher unless it makes an acquisition or really accelerates earnings, and I don't see that happening. Now, let's go to Mike in Pennsylvania. Mike.
Booyah, Jim. Booyah. I want to say how great it is to be on your very informative show.
Thank you. Glad you're on the show. Glad you're on the show.
From you.
Thank you.
Lam Research.
Lam Research is going down too much. Now, I know this is a dangerous thing to say, but when you have a phenomenal company like Lam Research and it is down from 1,130 to 730, I'm sorry, that to me is an overreaction, and I'd rather be a buyer, but buy it slowly. Do not buy it all at once. That will only lead to pain. Let's go to Bill in North Carolina. Bill.
Hey, Jim. Thanks for taking my call. You Philadelphia Eagles are playing my Green Bay Packers tonight. Should be a great game.
I just want a great game. That's all I want. That'll be fantastic to see those two teams in action. How can I help now?
I watched an interview on CNBC with the CEO of Eastman Chemical, ticker EMN.
Yes. He's a very smart guy. I've been able to sit down with him too, and I think the stock with a 3% yield is one of the better plastic stocks in the market. And that, ladies and gentlemen, the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, game on. Do you have what it takes to stay diversified? Call Cramer and find out when we return.
Jim Cramer, the diehard of the dollar.
Hey, Jimmy, love the show. My 5-year-old grandson loves to watch your show.
I have to thank you for making us money when it's there to be made.
Our world is a better place with you in it.
As I said throughout the show, this market is just plain ugly. But your best defense against weeks like this is a diversified portfolio. So as we close out the worst week of the year for the S&P 500, and it was painful, I think it's the perfect time to play MI. Diversified. This is where you call me. You tell me your top 5 holdings. I tell you if your portfolio is diversified, or maybe you need to mix it up a little. Got to be sure you can't be too concentrated, as we saw from tech. Wow, it can be difficult. Let's start with Keith in Wisconsin. Keith, you're first caller. What do you got?
Booyah, Dr. Kramer. Thank you for taking my call today, especially on a day like today. I'm a longtime watcher, third-time caller, and original member of the Investing Club. I especially I especially like your Sunday educational newsletter pieces. You've kept me invested through this turbulent market and given me such invaluable education and helped me high-grade my portfolio. I really appreciate that.
Wow, you listen to what we're about, man. That's great. The Sunday piece takes me a very long time, but to hear that you appreciate it means I'm inspired for this Sunday. How can I help?
My 5 stocks are Own It, Don't Trade It, Apple, Caterpillar, Costco, Eli Lilly, and Own It, Don't Trade It, NVIDIA.
All right, let's go to work. Thank you, and thank you for those incredibly kind words. Thank you so much. Okay, so Eli Lilly, we know that people like that GLP-1. We did some selling earlier this week because we felt like we hadn't booked enough profits in the name. Apple, Own It, as this fabulous caller pointed, it's Own It, Don't Trade It. Caterpillar, I listened to Jim Appleby last night, and I thought he said such great things about the data center and all the different activity from infrastructure. It makes me feel terrific about it. All right, I'm going to come back to NVIDIA in a second. Costco had a great month. People didn't matter. They sold it anyway, but the numbers were better than expected, which brings me to NVIDIA. Okay, now, here's the problem. Apple and NVIDIA are 2 of my absolute favorite companies. I didn't say stocks, I said companies. My thinking is, do we make an exception in this particular case for having this much tech? The answer is no, not in a 5-stock portfolio. In a 10-stock, yes. But in a 5, we have to accept the fact that this is not diversified. Doesn't mean you want to sell it. But we have to understand that we're playing diversified, and that's not diversified because we have a drug company, we have a retailer, we have a machinery company, and we have 2 techs. So no to the diversification, but yes, I understand, and I hope you have others to dilute that because it's just too much tech for a 5-stock portfolio. How about we head down to Phil in North Carolina? Phil!
Hey, Jim. How you doing today?
I am doing well. How about you?
I'm doing fair to middling today, Jim. Fair to
Midland's just okay.
Fair to middling.
Well, it's such a horrible market. I'm trying to keep up a good face in this. I know it was a terrible day, and Jeff Marks and I talked about it like 100 times today. This was one of the worst days in a long time. So we get that. We want to move on from it. We've got a lot of cash. We're just going to keep going forward. How can I help you?
Right. You got to take advantage of these days.
Totally right.
I'm going to give you my 5 stocks, and I'm not going to give you the stocks that I own. You know, the Metas and the Apple. So don't bother replacing it with one of them. I'm going to give you some stocks that are not as popular. But
I like that.
My 5 stocks, I got plenty of Microsoft. I got all that stuff. Arista Networks, IBM, Verizon, Morgan Stanley, and one I'm not too crazy about, GE Healthcare.
All right, let me go to work. I think this is a really interesting portfolio. And I'll tell you why. It's really interesting because you've got some yield here in Verizon, some at IBM and Morgan Stanley, and that should be preserving, if not buoying stocks. It's not today. It didn't seem to matter, but I point that out. Arista is a terrific networking company. Jayshree Yalal is so smart. This thing has been an amazing player. All right, Arvind Krishna is doing a terrific job in reinventing IBM. Verizon, I didn't really care for that deal because they could have bought it a couple of years ago for much less, but they did buy it and gave them 13 million new homes. That was very smart. Morgan Stanley, this last quarter was actually better than the last 5 quarters, so there's hope. I didn't like the way the stock just blew right through 100. GE Healthcare, I understand that you didn't like it, but remember, it did trade up to the mid to high 80s this week, and we're nicely profitable on it for the club. So I want to be careful in dooming that stock. It's made a nice move here. So we have healthcare, we have financial, we have telco, we have tech, and we have tech. Can't have tech and tech. This is not like having Apple and NVIDIA. This is different. We're going to keep Arista, all right? And what we need, let's say, oh no, man, I got a lot more people I want to play here. What I want to do here, have you watched the action in Abbott? This is med tech, and Abbott acts so well today. I really like it. Let's swap that one out and do that. All right, I like to say there's always bull market somewhere. I promise it just for you right here on Mad Money. I'm Jim Cramer. See you Monday.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.